Welcome back to Accounting 2, and we are in Chapter 14, taking a look at worksheets. In our prior video, we went over the idea that we journalized and we posted all year long. We got to the end of the year. We took our general ledger, old school 3-ring binder that has every single account that we have in our company, and we open it up and we go page by page, and we write out every single account and its balance in what we're calling the trial balance, right? Same thing we did back in Accounting 1. We get to the bottom of that trial balance and we make sure the trial balance balances, okay? If it doesn't balance, we got to go figure out why. We then go ahead and move on, and we're going to do the simple adjustments, the same ones we did in Accounting 1, with the using up of supplies and insurance. The asset got smaller, the debit expense got bigger, record those and move on, right? I need you on page 415 in the textbook. We're going to take a look at raw material now. Again, in Accounting 2, we're a corporation, but we're also a merchandising business. So we are going to acquire raw material, we're going to do something to it, and then we're going to turn around and sell our product. And we're going to mark it up and sell it for more than it costs to build. Story I'm going to use is when I was in college, I'd worked for a place called Rainbow Play Systems, and they're a wooden swing set company. And I spent about 1.5 years in the shipping department where we had a big conveyor belt and a machine that had wrapped plastic around the pieces of wood, and I'd stack it up on a cart, like a 4x8 cart with rollers on it, bind stuff together, and I'd push it into semi-trailers. That was my job. 8 hours a day. Wasn't that much fun, but it was a great workout. Next 1.5 years, in same time in the summers, I worked in the saw room. So I'd get a big old bundle of wood, 20-foot long 4x6s, because I was a slightly bigger than average guy. And I'd move them on this other kind of conveyor belt, and I'd measure out, and we got a Model XJZ 427, and it needs 6 of those, 8 of those, 5 of those, 2 of those, right? Lengths of wood. Get it to the machine, cut it, move it on, and then they'd router it and sand it and all that kind of stuff. So I'll probably come back to Rainbow Play Systems and talk about that as my example. So circling back here to raw material. Do you always sell every piece of raw material that you purchase in a given year? Right? We have a fiscal period that starts and ends, and it's an annual fiscal period now in Accounting 2. But on December 31st, do you have every single piece of raw material that you purchased gone and out of your shop? And I think you guys would say, well, no, that's probably not going to happen. Do you sometimes get a good deal on some kind of raw material and buy it in bulk? And again, you don't want to buy stuff that's going to deteriorate and you're going to have to throw away. But if you get a good deal on something, maybe you'll buy a bunch of it, right? So we need this new asset account to track the raw material that we're going to carry from one year to the next. That new account is called merchandise inventory. We're not super creative in accounting. That's okay. It's an asset, so it's going to have a debit balance. It's going to increase on the debit side. It's going to decrease on the credit side. If you look at the Google Sheets chart of accounts, we've added several of those accounts on there, and merchandise inventory is one of them. It's a current asset, meaning it's going to be used up, or parts of it is going to be used up within a year. It's not really meant to be long-term and usable for 10, 15, 20 years. That's more what we're going to call a plant asset. So here's our example merchandise inventory, and we'll get to how this number shows up here in a second. So let's say we're Rainbow Play Systems and we're starting up brand new year 1. Never started before. So we look at it. We don't have any merchandise inventory. We don't have any purchases. We're going to go ahead and purchase that raw material over the course of the year. It's going to go into the swing sets that we make. So at the end of the year 1, we still don't have any merchandise inventory, but we know we've purchased $200,000 worth of wood and dowels and coated chain and cable and tires and slides and whatever it is that goes into our product. We have used up some of that $200,000 worth of raw material in the products that we've sold, right? We build these swing sets, we manufacture them, and then we sell them. Did we sell every piece of 2x4? Probably not, right? So someone is going to get stuck going out in the yard and counting up all of the inventory we still have left. Whatever that number is, just like supplies, is going to go on the balance sheet side of our worksheet. Okay? We're going to report what's left, and whatever's left is eventually going to get transferred into this merchandise inventory account. So let's kind of keep following with this story here. You're stuck going out and counting up all the inventory that's left, and let's say what's left is $50,000 worth of raw material. So the purchases account, it's a temporary account, like an expense account, like a revenue account. It's going to get hit to zero. That stuff we'll do in Chapter 16. So at the end of the year, we're going to transfer this $50,000 into now merchandise inventory. So the start of year 2, we have a merchandise inventory of $50,000, meaning, hey, how much raw material are you carrying forward from year 1 to now year 2? And our purchases goes back to zero because that's a temporary account. So year 2 comes, we're going to buy more raw material, we're going to make more swing sets, we're going to sell more swing sets, and we're going to keep moving. So we're going to purchase, in that purchases account, $300,000 worth of, again, 2x4s, 4x4s, slides, tires, coated chain and cable, whatever it is. At the end of year 2, we got $50,000 worth of old raw material on the books, and we have $300,000 worth of new material that we bought. Okay, so how much is left? Well, we don't know. Somebody's got to go back out in the yard and count what's left. So our question is, did we sell all the new stuff? Did we dip into some of the old stuff? Or did we not even sell all the new stuff we acquired? So until you go and do the physical count of what's left and plug that number into the balance sheet, we don't really know how much is left and how much was used up. So our trial balance number is going to be that $50,000, the balance of merchandise inventory. You go physically count up the amount, You go count up the amount of merchandise that's left on hand, and that's going to go in the balance sheet. In this example, we got $75,000 worth of 2x4s, 4x4s, tires, slides, chain, cable, whatever. So what does that mean? Well, we used up $275,000 of the $300,000, right? The stuff we bought in year 2, we didn't use it all up. Well, how do we know that? Well, because this number here got bigger, right? The ending inventory, just like supplies, well, sort of like supplies, right? Supplies is always going to go down, right? You're not going to grab this pencil and see it multiply, right? You're going to use the pencil up. Supplies is always going to go down. Well, merchandise inventory goes up with purchases, goes down with sales. We acquired $300,000 worth, but we maybe didn't sell as much as we did in the past. So we only used up $275,000 worth of that raw material. So we got a situation where merchandise inventory needs to go up by $25,000. It's got to go from 50 up to 75. Again, our worksheet is a big old scratch sheet of paper. It's a planning tool. We're going to have to do an adjusting entry to make that happen. So the trial balance number is 50 in this example. It needs to go up to 75. So here's our adjusting entry. A debit to merchandise inventory because the asset is getting bigger, and a credit to income summary. So we hit the trip meter and set our temporary accounts to zero. After that adjusting entry, merchandise inventory is now at $75,000. Purchases at zero, and we're going to start year 3. We bought $400,000 worth of, again, 2x4, 4x4, tires, swings, coated chain, cable, slides, whatever. End of the year, someone's got to go out and count up how much inventory we got left. Well, when you get done, I got 6 of those, 8 of those, 12 of those. You value that inventory at $65,000. Okay? Well, what does that mean? Well, we used up all $400,000 of the new stuff, and we dipped into a little bit of the old stuff, some of the year 2 and year 1 leftover wood and coated chain and cable and whatever. So we have $65,000 left in our merchandise inventory. That's the balance sheet number. Okay. All 400 of the new stuff used up 10,000 of the old stuff. So again, the trial balance was 75, the balance sheet was 65. Well, what happened? This asset got smaller. So merchandise inventory has to go down on the credit side for 10,000, and the other half of the entry is going to be income summary for 10,000. It's a unique account where it could go up, like the first example, it could go down, like this second example. So let's jump forward to our textbook, page 415. We have $140,480 in this example for Hobby Shack, right? Jump forward to page 416, 416, and as you read in the instructions there, it says we have $124,640 worth of merchandise inventory left, right? That's over here on the far right-hand side in the balance sheet column. We can't see that, right? So we went from 140 down to 124. We're going to use up $15,000 worth of inventory, right? We're going to use all of our current purchases, and we're going to dip into the old inventory to the tune of 15,000 bucks, right? So as we look at it, we started with 140. Balance sheet number, we ended with 124. Well, what happened? We went down $15,000, so that is a credit to merchandise inventory and a debit to income summary in this example. So plug in your debit amount, plug in your credit amount, and label your two parts for our adjusting entry. Here's a different example. You're going to see it on page 417 in the textbook. What if we started with $294,000 worth of stuff, and now we ended with $298, right? We ended up going up in merchandise inventory. That happens. It's going to be a debit adjustment of $4,200. This is in the wrong spot. This $4,200 should be over here on the right-hand side as a credit to income summary. Okay? So sometimes merchandise inventory goes up, sometimes merchandise inventory goes down. Take your trial balance number. Your textbook is going to give you your balance sheet number, and you got to figure out, did it go up or down? If it went up, it's a debit for the adjustment. If it went down, it's a credit for the adjustment. So the term we're dealing with this time is merchandise inventory.